Because I ignored one simple rule, I lost 88% on a single investment. And after 5 years in the market, I'm sharing 6 lessons that will help you avoid some of these costly mistakes I made. So let's get straight into it, starting with the valuation trap. Early in my investing journey, I was analyzing companies like Apple and Google, established giants with a long history, and then I found growth generation. On paper it looked incredible. I ran it through the same process I used for Google and Apple, not knowing I was making a fatal mistake. The more I dug into it, the better it seemed. Therefore I pulled the trigger and bought the stock, and soon it became my biggest position. A few months have passed and I began to realize something was wrong. The stock began to fall sharply and I didn't understand why at first. But then it clicked. I had only looked at Growth Generation's own historical multiples, without asking whether those valuations were sustainable. The company was trading far above industry averages and I completely overlooked this. The stock collapsed and I lost 88% of my investment. In this story, there are 3 important lessons to learn. Lesson number 1. Always look at the broad industry. Here you can ask yourself, is the company trading at a fair valuation compared to its peers? If it's trading at a premium, is this sustainable? Can a company justify its high valuation with future growth? If you cannot justify the company's high valuation, just move on, as there are other companies out there waiting for you. Lesson number 2. Cut your losses. As the stock declined and I realized my mistake, I should have sold it. Instead, I held on, hoping for a rebound and a smaller loss. But that never happened. Remember, a bad investment won't ever magically become a good one. Take a loss, learn from it, and move on. As we are moving to lesson number 3. Define your identity. At that time, I was considering myself a long-term value investor. Yet I let a speculative high volatility stock become the single largest position in my portfolio. There wasn't any strategy. It was just a recipe for a heart attack. If you want to avoid this, I can help you with these 3 questions. 1. On which timeline do you operate? Investing for retirement 40 years from now is fundamentally very different from chasing returns in 6 months. Understanding this distinction is key to deciding whether you are an investor or a trader. 2. What is your plan? This doesn't have to be complicated. You can use 3 simple pillars to get started and work out from there. First pillar is the contribution pillar. Here you can decide exactly how much and how often you plan to contribute. It can be weekly, monthly, and so on. The second pillar is the asset pillar. Here you define the specific financial instruments you will focus on and ensure they sit within your circle of competence. And the third pillar is the concentration limit. Establish a clear rule on how much risk you are willing to take with any single position and your portfolio in general. And now to the final question, what is the process to achieve your plan? Once you have defined your path and build your plan, you must establish a repeatable process. This is the method you will use to evaluate every opportunity. Whether you rely on discount cash flow model, EBITDA-based valuation, or a different framework, the secret isn't in the formula itself. It is in the consistency of your application. A disciplined process allows you to compare stocks objectively and you will strip away any gut feelings and hype. But even with the perfect process, there is one thing that can still ruin your returns. And I'm very guilty of this one. This is a lack of action. I can't tell you how many times my process gave me a green light on a stock I was analyzing. But I just didn't pull the trigger, or I bought a tiny, insignificant amount. Instead of trusting my process and buying at a set price, I was waiting for a little bit of an extra dip in the price. But hesitation has a cost. The stock took off without me. Remember, nobody can constantly buy at the bottom. Being mostly right and in the market beats being perfectly right and stuck on the sideline for the most of the time. If your process says it's a buy, buy it. But now let's move on to our 5th lesson, which is a psychological killer. If you make a mistake from number 4, stop looking in the rear view mirror. I sold Palantir early and I sold Meta early too. I still made great returns on them, but that's life. But now, sometimes when I see their prices, I calculate in my head how much I could have made if I held on. just stop doing this. Dwelling on missed gains drains your energy. You should rather focus on finding the next opportunity or improve your process. And remember again, nobody can reliably time the market. The golden rule: learn from the trade, turn the page and focus forward. The next opportunity is where the gain happens. But now let's move on to our final lesson. And for this one we'll talk about influencers. Early in my investing journey, I watched a lot of finance gurus here on YouTube. Some of their advice worked out, some didn't. But the real problem I see is in the risk tolerance. They might be able to afford a 10,000 loss, you might not. The key I'm now using is very simple. Once my analysis is done and the stock buy price is set, I watch videos to challenge my thesis. If a YouTuber hates the stock I love, I listen. They might be pointing out to a blind spot in my own process, something I hadn't considered or I missed. That's how I use influencers productively, and not to tell me what to buy, but to confirm or reject my thesis. And remember again, we all make mistakes. The important part is to learn from them and improve your process. To make sure you don't have the same blind spots I did, I've put together a playlist of how I build my models today. You can watch these videos over here, and I'll see you there.